When I analyze a stock, I don't start by asking whether it's cheap. A cheap stock can still be a terrible investment. Instead, I start with three simple questions. First, is this a quality business with strong fundamentals? Second, is this a company I would actually want to own? And finally, is the stock an attractive opportunity today? Today, I'm going to apply this framework to Rollins, ticker symbol ROL, and I'm going to answer all three of these questions. Before we start, I have to disclose that I currently have a long position in the stock. I own roughly 227 shares, with a market value around $8,500. And this is roughly 1.67% of my total portfolio. I am in the red on this position by about 21%. And this stock is projected to generate about $165 in annual dividend income for me over the next 12 months. Alright, let's dive in. And let's start by finding out if Rollins is a high quality business. I'm going to start this analysis by looking at the yield or quality score that can give me a quick sense of whether Rollins may or may not be a high quality company. And the score suggests that it is. The stock has a quality score of 92, which is excellent. This score is made up of three individual parts. The first part is the dividend profile the stock presents, and Rollins earns a solid 85 out of 100 here. The second part is the growth profile for the company, and Rollins scores a perfect 100 here. And finally, we have the financial stability component, where Rollins receives a very nice score of 89. So at face value, we can make a strong guess that Rollins will be a high-quality business based on its fundamentals, and that it will have an attractive dividend profile. But let's do a little bit of due diligence to make sure, and I'll start with the growth profile first. Here, I like to narrow in on two of my favorite metrics, free cash flow and return on invested capital. Free cash flow is one of the most important, if not the most important metric for any company, because cash flow is king. Companies need cash flow to pay for expenses, fund operations, reward shareholders, and grow the business. Rollins' free cash flow per share chart looks very nice. We can see a pretty consistent upward trend over the past decade or so. The 10-year CAGR is a very impressive 15.46%, while the 5-year CAGR is a more modest, yet still very strong 9.86%. And to me, this is a very fast pace of free cash flow growth. The company has grown its free cash flow per share from 22 cents in 2010 to $1.34 in 2025. And that means free cash flow has grown by a factor of roughly 6 times in the span of 15 years. Now, the second growth metric I like to review is return on invested capital, or better known simply as ROIC. ROIC measures profitability on invested capital, and I believe it goes hand in hand with free cash flow. Because what's the benefit of generating a lot of free cash flow if you don't have opportunities to reinvest that cash into profitable, revenue-generating ideas? I personally consider a ROIC above 20% to be excellent, and Rollins currently has a ROIC of 20.1%, right in line with my excellent threshold. We can see that the 10-year average ROIC is a more impressive 23.6%, and that is because the company had an even better ROIC between 2012 and 2018. With the profitability metric sitting close to or above 30%. This is not a concern for me. Obviously, I'd prefer to see a steady ROIC, closer to 30%, for the full past decade. But the company has been able to sustain profitability in or above the 20% range, which is very good in my book. Let's take a look at one more fundamental metric in this category before we move into financial stability. And I'm going to quickly scan the company's margins. The gross profit margin is about 50%. The operating margin is above 18%, and the net margin is about 13.5%. In my opinion, these are very strong margins for a pest control company. The gross margin tells us that Rollins retains about half of its revenue after direct costs. An operating margin close to 19% is also considered quite high for this type of business. And the net margin tells me that for every dollar of revenue the company earns, it converts roughly 14 cents into income. I'd consider that pretty strong as well. So overall, the business looks attractive, margins are healthy, free cash flow has grown very quickly, and management has been able to find profitable ideas for reinvestment. Let's move on to financial stability. And the two metrics that I like to review are the free cash flow to total debt ratio, that tells me how much financial flexibility the company has, and the interest coverage ratio, that tells me how much of earnings are being used to service the cost of debt. My favorite companies have strong liquidity, and they are ones that generate a lot of cash without having a lot of debt. Rollins has a free cash flow to total debt ratio of 0.56, and that means the company generates enough free cash flow each year to pay about 56% of its total debt. That is a great balance. I like to see this liquidity metric be at least 30% or higher, and Rollins meets that benchmark. The company could essentially pay all of its outstanding debt in less than 2 years if they needed to. The interest coverage ratio stands at 21.8, which is also excellent. Ratios of 10 or more are considered very strong, and Rollins' ratio is twice that ideal standard. Okay, so we have a track record of strong growth, high profitability, and strong liquidity, with high cash generation relative to debt utilization. This is exactly the type of business I look for. And you may have noticed that I left the dividend profile for last, and that is intentional, because I want to make sure I'm looking at a high-quality company before I even decide if the dividend profile matches my strategy. If I started the review looking at the dividend metrics, I could be wasting my time if the business fundamentals didn't align with my expectations. Alright, since we like the business, let's dig into the dividend metrics. The forward dividend yield currently stands at 1.93%, which for me is pretty attractive, given that my overall dividend yield on my portfolio is about 1.37%. The payout ratio is 64.5%, which is pretty good. I'd prefer to see a lower ratio, but we'll take a look in a moment at how stable this ratio has been over the last decade. The company has a strong dividend growth streak that spans more than 2 decades. And dividend growth has also been quite attractive, with the 1, 5, and 10-year dividend CAGRs all in double digits. The company last increased its dividend in October of 2025, and that was a sweet 10.61% dividend bump. The 1-year dividend growth rate was 10.16%, and that's measured from calendar year 2024 to 2025. The 5-year CAGR is a very impressive 23.07%, and the 10-year CAGR is also very nice at 16.89%. We can tell that dividend growth has been slowing down over the last decade, but still remains very strong in my opinion. Not many companies fall into this bucket of double-digit dividend increases. Rollins also had a history of paying out special dividends through 2021. They haven't paid one in the past few years. But from the dividend chart, we can tell that even though the special dividends have stopped flowing in, the pace of growth seems to be holding pretty steady since 2020. The 10-year average payout ratio sits at 63.8%, which is right about where the current payout ratio sits today. The company has consistently held its payout ratio in that 60 to 65% range since 2012. And this tells me that future dividend growth can still be very attractive. If the company has a history of paying about 65% of earnings as dividends, and it is growing free cash flow at a healthy pace with strong reinvestment opportunities, the low double-digit dividend growth pace may continue in the future. So everything looks very nice, and I can confidently answer my first question, that I believe Rollins is in fact a high-quality business. Now we can move on to our second question. Is this a business I actually want to own? And you would think that if you believe a company to be a high-quality business, naturally you'd also like to be an owner of that business, but that may not always be the case. To properly answer the second question, we want to think about things like, do I actually understand what this business does? Do I think this business is sustainable in the future? And does it operate in an industry that can still grow? Each of us will have different answers to these questions, but they are very important things to think about before you invest in any business. For me, Rollins is pretty easy to understand. If you don't know anything about a company that you're researching, the best place to start understanding the business is to read the About section. Here we can see that Rollins operates a network of subsidiaries that specialize in delivering pest and wildlife management solutions to diverse clientele, like homeowners and commercial businesses, and they operate in the United States and globally. And this is just a fancy way of saying that they are a pest control company, and that I can easily understand. Whether you're a homeowner or you rent, odds are you've likely had to deal with some type of pest. Sometimes dealing with pests is easy, but sometimes you find that you need professional help. And when there is a nuisance in your house, you're not going to leave it unresolved. You're going to fork up the money for someone to come and clean up the mess. And this is where Rollins comes in. They help you fix that pest problem. And if you've ever dealt with a pest control company, you probably know they usually upsell you on an annual or semi-annual plan to come spray the perimeter of your house to keep it pest-free. And this is easy, recurring revenue for them, and many homeowners are happy to pay this fee to stay bug-free. Businesses use these services as well. A lot of restaurants, hotels, or any type of business that has physical clients needs to maintain a pest-free environment to conduct their business. I personally think this business model is sustainable in the future. Pests are extremely difficult to get rid of, and oftentimes they just come right back if you don't upkeep maintenance to keep them out. So I believe Rollins will have plenty of future business opportunities for years to come. They are also a very large company with a market cap of about $18 billion, which gives them plenty of pricing power to keep margins steady. The company's size also means that they can more easily acquire smaller companies and grow by capturing more of the existing market. So, to answer my second question, yes, Rollins is a business I actually want to own. And if you'd like to know more about the company before making up your mind, you can always take a look at their latest earnings report to learn more about how they're doing. So let's take a quick look at some highlights from Rollins' second quarter earnings results that were reported at the end of July. At a high level, quarterly revenue grew by 7.9%. 5.7% was organic growth, with the remaining 2.2% coming from acquisitions. Earnings per share grew by 6.7%, which is pretty strong, but free cash flow declined by 1.2%. I wonder what happened there. Okay, so we have a small bullet point here on the right that explains what happened. Free cash flow was negatively impacted by the timing of payments associated with tax credit planning strategy. But otherwise, cash flow generation remains healthy with conversion at 115%. And that is an absolutely phenomenal free cash flow conversion rate. And we can tell that this was a one-off item that impacted free cash flow, and likely not a big deal in my opinion. The next slide gives us a breakdown by segment, and we can see that all three segments, residential, commercial, and termite, saw organic and acquisition revenue growth, which is very nice. The EBITDA margin declined by 1.2%, and this was due to lower volume, higher medical-related costs, and fuel headwinds. That's definitely not ideal, but it sounds to me like these are one-off items as well, and they may not be recurring pressure on margins going forward. The next slide is interesting. Here we can see how Rollins used its free cash flow. $88 million was paid out as dividends, $6 million was spent on capital expenditures, and $117 million was used for mergers and acquisitions. And this is actually very useful information, because as we saw earlier, Rollins is able to reinvest capital at a high rate of profitability. If you recall, the ROIC was 20.1%. And having a great ROIC is excellent, but also being able to find a lot of opportunities to reinvest your cash is important. So here we can see that Rollins is finding a lot of smaller companies they can acquire to expand the business, with the bulk of the cash flow being directed towards M&A. And let me just touch on the growth algorithm reported on page 10 here. The metrics from the last 3 years look great. Revenue growth of 12% per year, an EBITDA margin of 25%, and 121% free cash flow conversion. 2026 looks a little bit weaker, with revenue growth of 8 to 9%, depending on how M&A plays out. A much weaker margin of about 10%, but free cash flow conversion still over 100%. And here's the more useful piece of information, the guidance for management. The midterm outlook for revenue growth is in the range of 9 to 11%. I think that's very strong for a mature pest control company. Margins are expected to improve considerably to a range of 30 to 35%, and free cash flow conversion is expected to remain very healthy, above 100%. So again, in my opinion, Rollins is a high-quality business with a strong track record, and I think it should continue delivering strong growth in the future. And now that I know I would like to own this business, let's decide if it's attractively valued and what potential return we can expect from it going forward. I'll jump over to the valuation tab. And right away, I can see that based on the 3 valuation models here, Rollins appears to be trading for a potential 34% discount. Matter of fact, all 3 models, the price-to-earnings model, the free cash flow model, and the dividend yield theory model, all give us roughly the same fair price for the stock of about $57. Each of the valuation charts shows the stock has sold off quite a bit since early 2026. It peaked around $65 per share in February and has declined to about $38 today. That's quite a steep sell-off. But even though the valuation models point to a potential discount, it's still a good idea to consider the absolute valuation. Rollins currently trades for a price-to-earnings ratio of about 34 and a price-to-free cash flow ratio of about 29. In absolute terms, both ratios are quite high, considering that long-term market averages for these ratios are about 15. Now, we can see that during the last decade, investors have been willing to buy Rollins at quite high multiples. The PE ratio generally sits above 40, actually closer to 50, and the price-to-free cash flow ratio has generally been above 40 as well. What this tells me is that relative to its own history, the stock looks attractively valued, but I would view this 34% discount with a level of caution. If there is an economic downturn around the corner, these absolute valuation multiples can certainly be compressed even further. And if we take a look at the historical yield, we can see that today's yield of 1.93% is actually one of the highest yields the stock has paid since 2017. And sure, there may have been similar or better opportunities in that span of time, but on average, Rollins has not paid a yield above 1.5% since 2017. So from a pure dividend perspective, it looks quite attractive. Matter of fact, the actual 5-year average yield is just 1.25%, which is 35% lower than the current yield. So let's take all of this information and figure out what type of return we can generate from the stock if we invest at today's price. I personally like to invest for the long term, but it's only sensible to estimate a return potential for the next 5 years, since anything beyond that time frame is too far out in the future and many things could change in that span of time. In my opinion, there are 3 drivers of future return: the forward dividend yield, business growth, and valuation expansion or contraction. So let me pull up a spreadsheet and let's crunch the numbers. I'll start with the yield since it's the easiest. The forward yield for Rollins is 1.93%. Next, let's add the return to fair value factor, which is the valuation expansion in this case. Let's assume the 3 valuation models from Yielder are accurate and the stock is in fact trading for a 34% discount. The current price is around $38 and the fair price from the models is around $57. And that gives me a potential upside of 50%. If the stock price climbs from $38 to $57, that is a 50% return on our investment. Now, we shouldn't expect that to happen overnight, so let's assume that this reversion back to the mean will happen slowly over the next 5 years. And by annualizing the 50% upside potential over 5 years, we get an annual growth factor of 8.45%. And to complete the return potential calculation, we need to estimate how fast the business can grow. For this, I like to use projected earnings growth for the next 3 to 5 years. And the consensus analyst estimate for Rollins stands at 8.97% right now. So, if we simply add these 3 drivers of return together, we get an annual return estimate for the stock of 19.35%. Now keep in mind, this is just an estimate, and it's based on the assumption that the stock is discounted, that it can revert back to its long-term fair value, and that the business can grow at about 9% per year for the next 5 years. But a 19% annual return over the next 5 years looks very attractive to me. I typically aim for 12% or better, so there is quite a big margin of safety here above my target threshold. And this is reassuring to me, because we can be wrong with one of our assumptions and still earn a very nice return in the coming years. For example, if we assume that we are completely wrong about the valuation of the stock, and there is no reversion to the mean at all, we would still generate a roughly 11% annual return based on business growth and the dividend yield alone. So to wrap this up, my answer to the final question, is this stock an attractive opportunity today, is yes. Rollins appears to be discounted relative to its own history, and its future return potential is well above my expectations. Plus, it includes a sizable margin of safety if any of my assumptions prove to be overly optimistic. I would likely add to my position at this price, and with this future projection. That being said, if any of you have followed me for a while, you may know that I track a quality investable universe made up of companies I would like to own, and I rank them based on opportunity. Rollins is currently ranked number 17, which means there are 16 other stocks that are potentially even better opportunities right now. I have added some capital to Rollins as the stock has sold off for the past few months, but most of my newly invested capital has gone to other opportunities. If you'd like to learn about the quality investable universe, you can check out my newsletter, Quality at a Fair Price. There is a link in the description below. And if you would like to analyze stocks the way I analyzed Rollins today, you can check out Yielder. It's a stock research and portfolio tracking app that I built along with my partners. The app went live just a week ago, and we are running a founding member discount right now through September 7th. I'll leave a link in the description as well. You can use Yielder to research any stock you'd like and to analyze your existing portfolio, project your future dividend income, and get new ideas from our custom-built playlists of the most attractive dividend stocks on the market. If you enjoyed the video, please do me a huge favor. Give it a like, hit the hype button, and subscribe to the channel. And if there is a stock you'd like me to review in a future video, let me know in the comments below. Thank you for watching and see you next time.